And so this might be you with your counsel and counsel for the lender negotiating. But like I say all the time, it's so important if you have a personal relationship with the servicer that you personally are engaging with that servicer in connection with your plan and your ask for modifications. When you lawyer up and your lawyer begins to be your sole or only mouthpiece for your deal, then it can start to be a strain on those relationships. So while I'm a lawyer and I enjoy negotiating on my client's behalf, whether I'm a seller, a buyer, or whether I'm acting as lender's counsel, I enjoy that process. But in general, remember, this is a relationship game. Just like investors invested with you because they like you, know you, trust you. Well, the lender has loaned you money largely based upon the financial performance of the property and your personal relationship with them. So get an understanding that you're going to have to negotiate with that lender. You might have to get a current broker opinion of value or a current appraisal, regardless of what the lender is going to do, to be able to use that as a negotiating tool. Ironically, if you get a broker opinion of value that shows that the value of the property is less than the paper, less than the promissory note, that actually gives you more ammunition, more evidence, more facts to be able to suggest to your lender that they might think about modifying your loan, because for them to foreclose on that asset and then sell it on their own balance sheet, they're likely to take more of a haircut on the value of the property than to allow you to sell that property, or to allow you to recapitalize that property, or for them to modify that property. You need to understand the comps associated with where your property is actually located, and you need to understand your lender's capital structure. What I mean by that is many lenders sell their loans off in whole or in part to other investors. And so depending on what your lender's internal capital structure is, they may not even have the power necessarily to modify the loan or restructure it. And that will certainly impact the plan that you're pitching to your lender, the negotiations that are taking place with your lender. And you want to understand all of those things. And then you want to understand market pricing, right? Market pricing is dynamic, depending on where you're at in the country, depending on what market you're in, depending on what sub-market you're in. It's super important for you to understand how a lender views this market and sub-market, for you to be able to take advantage of the negotiations. And then you need to be firm yet flexible. Ironically and sadly, the most leverage that you're going to have in this negotiation, especially on a qualified non-recourse loan, is be prepared to walk from the property. Be prepared to give the keys to the lender because your business plan didn't work out, or your property is a victim of these rising interest rates, or the explosion of rate cap costs, or explosion of utilities, or insurance costs. Those costs, as we've already talked about, can dynamically change the value of the property and your ability to perform under your business plan. So you got to be flexible yet firm with your lender. And that's step number 4. So what can he expect on step number 5?